Okay, hello everyone. So good afternoon and welcome everyone. My name is Elizabeth Eden, Marketing Associate with our firm Fiduciary Planning, and I am today's moderator. Today's topic will be a look at the various possible election outcomes and how they may each impact the models in your portfolios. Now for some Zoom procedures and housekeeping. During the meeting, please refrain from pressing the share your screen button so everyone is able to see the presenters at all times. You may turn your video on or off, which is located on the bottom left of the Zoom screen. I will have everyone muted for the duration of the meeting until we take time for questions and answers at the end. I would like to review our agenda for today. First, we will have Douglas Eden, our Partner and Chief Investment Officer, with some brief opening comments. Next, Tom Shorn, Partner and Chief Compliance Officer, and Douglas Eden will be speaking on our primary topic for today. Lastly, Doug Eaton will conclude with comments on your portfolios. If any questions may come up during the presentations, please keep track of them. You will be given an opportunity at the end of the presentation to write them in the chat box, which is located on the bottom panel of the Zoom screen, or to ask them live with your audio. Now, I'd like to welcome our first speaker, Douglas Eden.
Hi, thanks, Lizzie. Good afternoon, everybody. Real briefly, before Tom takes over, I just wanted to mention that this presentation is apolitical. We have designed this to talk to you about best practices, the models, how things will react. This is not to take a side, so please, when looking at the slides or listening to comments, don't infer anything about us picking a side. Our job is to prepare, not predict, and that's what we're going to do here. I should also mention that Tom did a great job with this deck, did a great deal of research, and I personally am really looking forward to hearing what he has to say, and then I'll jump in after Tom talks kind of about the landscape. So enjoy, and we'll look forward to hearing some of your questions later. Tom, go ahead.
Thanks, Doug. So here we are again, 2020, right? We started out with the virus in March, kind of hoping as we got through it that we would not end up in possibly another situation. We're not so sure, right, what the end result here will be. And we're really not sure, and it'll take years, right, when everybody will be able to look back. The hottest topic today is no longer the virus, right? It's not. It's the election. And depending on which side of the aisle you're on, there are certain, you have a certainty that if the other side gets elected, that we're going to have a problem. So imagine being in our situation. I get calls every day. And what's different about this than 2016 is this started a lot earlier, right? So 2016, it started about 2-3 weeks beforehand, where I was getting a call, and depending on which side of the aisle, and I got them from both sides, that if the other person got elected, the markets were just going to tank. Now, excluding, the pre-market of the night of the election, right, after it was determined that Trump was the winner, excluding that, it went up. And I'm going to show you something here very shortly about, certain things that happen in every single election, right? And so why don't we get started? And if we can, yep, thank you. And so let's take a look at the election year, right? And so here we have the election year. And so we're already into September. Now, what we're looking at is the months in the election year going back to 1950, right? And we can see in September and worse in October that the markets go down. It's not a big move, but it's still down. And so why is that? And we'll talk about that in a second. Let's look at the next 2 months after, November and December, and they go up, right? This is our average. This is our average for the election years that go back to 1950. So why is this? Well, let's go back to March. I want to step back again. And why did the markets go down so much and so fast, right? The company's earnings go down that fast. The answer is no, right? There was uncertainty. Are they going to go down, right? What does the future look like? Well, here we are with the same questions being asked today and the same concerns today. So in September and October, we have this average negative return on a monthly basis because we don't know who the president's going to be. The markets don't know. And so don't be shocked that if we end up with a negative both September and October, right? That's what our average are telling us. If we move forward 2 months, the markets now have certainty. Very important here, certainty in most cases, right? We're going to look at where there isn't certainty. So what I want to do next is take a look at the elections going back to 1928 and start looking at what were the results, right? And so here I went back to 1928 and I took out, and we just looked at the fourth quarter of the election year now. So if we look here, and I've let's go back, thanks. You know, I summarized it all on the right side. So let's pay attention to that a little bit. So we have the number of elections, 23, right? Democrats 12, Republicans 11. You can't get more 50-50 than, you know, on an odd number, right? The number of positive fourth quarters were 15, right? So 65% of the elections ended up with a positive fourth quarter. You know, the next thing I want to talk about, I think, is a little, I don't think it's a predictor. I think it's just what happened. And I'll say why in a few minutes. So out of the 15, when Republicans were elected, there were 9 positives and Democrats 6. Number of negative fourth quarters, right, were 8. So 34% of them, Democrats 50% of the time they got in were negative, Republicans too. And I want to talk about that really quickly, right? Because it certainly seems we should be voting for Republicans if we want the fourth quarter to be positive. You know, and my thoughts here are either you're lucky or you're not when you're elected president. Either you're elected into a good economy, a good market, or you're not. And as you can see below, I'm going to talk about 2008, and this should send that home for you. So average fourth quarter returns, the way that you see them on their chart right now, right? Republicans on average 2.3%, Democrats 0.4%. But I looked at 2008. So if you look at that on the chart on the left, that quarter alone had a negative 22%. So what do we remember about that quarter? The markets were already falling apart. There were all sorts of problems outside of the election. The election didn't cause that. So I said, let me remove it and see what happens. That really is an outlier there. That is not an election number. So when I removed it, the Democrats were 2.5% and the Republicans were 2.3%. Again, you don't really get much closer. What do? You could be 2.4%, but pretty darn close to the 50% mark, right? And so I think what I'm saying here is the markets like certainty, right? We had a lot of positive. I didn't take 2008 out on the top numbers that I've shown you. If I did, we would see a lot more certainty and forget the party, right? And I think that's what we have to look at here. The next slide I'm going to show you really drives that home, right? So what we did here was we took all the elections and we marked off in red, Republicans, blue, Democrats. And if we don't look and we just look at the graph itself, what's that tell you? Right? What that really tells you is you don't want to get out in a market, at an election, but it also really tells you you don't ever want to get out, right? Certainly we have a few bad times here. And there's only 2 presidents, I believe, that are in this chart where the markets ended up lower than when they started. And so first one would be Bush number 2, right? And the one all the way before is at the very beginning, Calvin Coolidge, right? Probably not many of us were alive when Calvin Coolidge was president. So most of us don't remember this. So what this, this kind of sort of sends home again that does the election matter, right? So every election we're in, we're certainly going to hear this time it's different, right? And there's a lot of different things now that I'm hearing from my clients. And certainly every election is going to be different. It's no different than every downturn. Every downturn is different, right? Starts different, ends different, takes a certain different amount of time to recover. Really, they're the differences, right? So what's interesting here as well, and I'm sure everybody can remember this, how many of these guys didn't get reelected, right? So we can remember Bush 1 and Carter, basically in my somewhat adult lifetime. Carter was when I was a teenager, still in high school. So the usual circumstance here is the incumbent gets elected. That's the usual circumstance. I'm not saying that's going to happen, but that is, the usual circumstance. So really what we have and what we looked at to try to determine what we do, right? So we need to look at this just like we needed to look at the virus to try to determine what are we going to do here. And so we really have 6 outcomes for the election, right? And let's look at the middle 4, because the middle 4 is most likely, is a very high probability one of these are happening. And so if one of those happens, right, Trump ends up very similar with a split Congress like he has. Trump ends up with a Democratic Congress. Biden ends up with a GOP Congress. Biden ends up with a split Congress. These have the higher probabilities. It's stay put. We're at gridlock. What we've seen go on, I think since the middle of Obama's first year, I think, he went into gridlock, which has remained. We believe that this is what will happen. And so what's our answer there? Our answer is stay put. And so what do we mean by stay put? Basically what we mean is, please, we don't want to sell. Doug will do his work and Doug will make his changes as he sees fit, very similar to what happened in March. But every time we get into this, and again, I'll go back to 2016, I had people asking me on both sides, I better go to cash before the election. And what a poor outcome that would have been for them. Because when you do that and you have a run up like we've had, it's very hard for a person to get back in, because here's what we normally hear. I'll wait till it goes back down, where I got out. And does that ever happen? Sometimes it does, sometimes it doesn't, right? You'll get caught. So we're in a stay put. We're going to talk about 3 different return outcomes here in a minute. And some of them return outcomes will deal with, the 2 outliers, the top and the bottom here, right? But really what we're trying to say, the first 4, the middle 4, that's a stay put. Let us do our work. Don't worry. And I'm not saying on the 2 outliers, go to cash. I'm not. We're going to talk about that in a little bit. But we're really looking at what has the highest probability. So what is our problem, right? I mean, what is our problem here? Do we have a problem? The answer is yes. We do have a problem, right? And so if we start thinking about, and what we'll see on the next slide is what our problems are. This, we firmly believe, will be a contested election. And where our problem really lies is an extended contested election. And so, look, we know there's more things than we could fit on this slide as to why this is a problem. But these are the things everybody's hearing about, right? This is on the news every night, no matter what news you watch, right? This is all over the news. So this and some other items will lead certainly to a contested election. And so just to summarize what we looked at very quickly, right? This was a very quick look, and we'll have this available to you in a day or two, by the way. The markets, as far as the election, the presidential election, like certainty. It does not care who is in the market, right? And so, you know, this year, what I'm hearing is, you know, Biden's going to raise taxes. You know, Trump's going to everything that Trump does, right? And these things are going to ruin the market. The economy is a cycle. The market is a cycle. The election won't change it. Remember where we're at. We're at gridlock. Not much will get through. So with that, I think what I want to do now is really turn it over to Doug. So we'll talk about, you know, a long-term contested election from 2000. I don't know if you guys remember Florida. So Doug, why don't you talk about that? Hang on one second, Doug. You're on mute. Hold on one second.
Rookie mistake. Hi, everybody. So who remembers Chads from the 2000 Florida results? We had 4 different kinds of Chad problems. We had swinging door Chads. We had hanging door Chads. We had dimpled Chads. We had pregnant Chads. And, you know, at the end of the day, this went on for 5 weeks. And what happened was, at the end of the 5 weeks, the worst it ever got was about a 12% max drawdown. And, you know, as Tom pointed out, that this is about uncertainty. And I think, you know, in large part because of people just trading the market. You know, one of the things that everybody needs to remember is that a stock is a business, and a business trades on cash flow and profitability and goodwill. And if you have a good business, let's just call it Microsoft. Microsoft is really valued, its present value is based on its future cash flows and goodwill. So is it really possible that the thesis of Microsoft or any other good company was in any way damaged or materially changed by this? No, of course not. But what happens is the good trader will take advantage of something like this, and this went on for a while. As you see, it immediately kind of came back halfway back up. And, you know, as Tom showed on that mountain chart, you know, there's a steady march of equity upwards to the right. So, you know, I think that once again, if you're looking at some volatility, keep it in context. A 10, 12% move down is some volatility. That's all it is. And we'll get into some of the potential outcomes a little later in the presentation, and we'll talk more about this. So, you know, the primary thesis today is that very often the human condition is that I got to do something. I got to make a change. I must act. I must be in control. And in this case, it's about I want to beat the market. You know, I got to get out, and I want to make sure that I make the most out of a potential drawdown. And in actuality, in many cases, the hardest thing to do is nothing. Just don't do anything, and that's very tough. But most likely, even if you're a passive investor without an advisor, it'll result in a better outcome. And one of the reasons I really liked this slide was because the average investor, left to his or her own devices over a 20-year period of time, emotionally investing or in some way thinking that they could beat the market, far underperformed. 40-60 model, 60-40, the S&P 500, certainly gold, REITs. So this, you know, this slide shows us that while you may be tempted to invest or not invest or get in or out based on your political beliefs or how you feel historically, it's not gonna end well, and you'll probably perform more poorly. So I want to go through these next couple of slides pretty quickly. It's basically pointing out the three scenarios that Tom showed us, and then we'll get to kind of the meat of this. So, oh, there's the arrow. I was looking for that. Okay, so this right here represents one scenario. We don't think it's likely. This is a clean result. This was actually 1984, Ronald Reagan's second election, where he essentially swept almost every state with the exception of a few. And in this scenario, what we believe is that in reality, if COVID is lower and there's a very high turnout, the incumbent theoretically would win. We don't actually think this is a likely scenario. I don't think anybody else does either, but we'll talk about the potential upside market result if this were to happen. The next scenario is you have legal challenges. In my estimation, and Tom and I have talked about this, this is probably baseline. This is probably where we are. It will obviously be divisive. We have a Supreme Court with 5 conservative justices, and as everybody remembers, in 2000, it wasn't necessarily a very cohesive type of situation, and it wasn't very smoothly handled. The court passed on ruling on it and threw it back to Florida, and as you know, Gore ended up winning the popular vote in the country, but Bush won the state by about 500 votes, got the delegates he needed at 270. Gore ultimately had 266, and there you go. But I think that if you're looking at either side of things, okay, let's take that approach. If there's White House meddling or other meddling, if there's shenanigans with the post office, you can see that this is a situation that could cause some distress in the markets, because that's what we're talking about. We're not handicapping how this will all go, but in reality, this is probably the scenario we see. And then the next scenario, this is really a supposition that Joseph Biden wins, and the thinking of a lot of people is that he rolls back cap gains taxes to higher levels where they're theoretically regular income rates. This is not without precedent. When Obama came in, he was, in theory, going to roll back Bush-era tax cuts, the EDRA. And, there were a lot of famous stories about people selling businesses thinking that their tax, would not be cap gain, but regular income. One of the more famous stories is Wayne Huizenga selling the Dolphins and, to Stephen Ross. So in any event, this scenario comes with kind of a triple witching, so to speak. There's a lot going on in addition to this potential cap gains raise in the rate. You also have end of year tax loss selling, which generally creates some volatility. In addition, you have this parabolic move in the market of 60, 55 some odd %, and people will take profits. There's a lot of stuff that is in the tech sector, the FANG stocks, gold. Certainly people may feel it's time to take some money off the table. You have these three things working together. But I want to stress, it's volatility. Yes. Is it risk? No. One of the things that we've gone through together many times is that, the risk really comes from time horizon, not understanding when you may need money or bailing out of something and you take a loss. Or worse, maybe you were up, but then never got back in and you missed the next 15, 20% move. Remember, we don't really know, or do we care, the next 25% move in Apple. But you know what we know for sure? Where the next 100% move in Apple will be. And it's not going to be down, it'll be up. And it's a function of time. So if you want to think about it like coal and diamonds, let the coal turn into a diamond and don't try to outguess it. So these were the three scenarios. Now, what does that all mean in terms of return? We have a good result where it's uncontested, And this is modeling software that we use, by the way. This is not, we didn't get Nostradamus on the phone and have him, read us some return speculations. This was, algorithms that we plug in to stress test any number of things in the portfolio. I think it's kind of a fun parlor trick. If you ever want to have a stress test anything for you, oil, interest rates, COVID-2, vaccine that works and a vaccine that doesn't. There's any number of things we could run. So the baseline scenario, which is really where, we think things will probably play out, has a delta of 10% down. And then of course the cap gains is, what does this say? A 15% move down. And, once again, I think that's really a doomsday scenario for a lot of people because, that materially affects cash flow and, in terms of dividend income and people selling stock to live on. So people would typically bail first. So that's essentially the worst case scenario. And once again, if you're thinking about the logic of doing this, we stress that there's flawed logic in the urgent and emotional reallocation, not only as a long-term detrimental effect on return, but let me put it this way. If you look at benign neglect and the non-interference theory of that, it's typically the key to a passive investor success. Changing your investment policy, the rules of the road by which you manage your portfolios, you're likely to be wrong, especially if your plan's not changing. You don't change your investment policy unless your overall plan is changing. And when you do this investment policy change with great urgency, you're guaranteed to be wrong. So I want to go through a couple of, sort of logical ways to look at this, where you're trading certainty for uncertainty. You're trading an uncertain result for a certain result. So first of all, let's use a very easy example, and that is you have a taxable account. You have a non-IRA account with a brokerage account in it with, let's just say, $100,000, and you have some positions there that you feel like you want to bail out on, and you want to beat the market and go to cash or do whatever it is that you're going to want to do. So now, let's just say that you have a belief that you can sell Apple at the exact right moment before it's going to fall and then get right back in. And let's play along and assume you could do that. And let's just say that you've booked a 50% gain in Apple in the last several months. And what you're going to do is you're going to sell that 50% gain, and let's just call it $5,000 for argument's sake. So you take a $5,000 regular income tax hit, whatever your income tax bracket, because this was a new position and you wrote it up. Well, what's going to happen is you take your 50% and it turns into 25 or even 20%, depending on your tax bracket. That's a certain result. And then you compound the mistake because there's very little chance you're going to be able to get back in right at the bottom. The shortest amount of time imaginable is the time that it takes a stock to go down and then up. You don't get it right. So you're locking in a certain type of loss just from missing out on the up and certainly a tax hit. The next thing we could talk about just in terms of flawed logic is that your knowledge about anything is about the past. You know the past because it existed. You can't know the future. But what's important about the future are your decisions, right? Knowledge is the past. Your decisions are about the future. So if we make that assumption and we make the assumption that we do have a drop in the market, well, what can you decide to do? You can buy into the market. You have a well-balanced portfolio. You have cash. You have some fixed income. You have alternatives. Maybe you have cash on the sideline. You can buy Apple or Microsoft or what have you at a 10, 15% discount. So as a lot of us tell our kids or tell other people, look, it's not what happens to you, it's what you do. So the logic of an uncertain result and you compounding that mistake by not acting on it is the problem. But if you can make that decision to buy into it, you win. So I'm going to move on, and we'll get into the models in a second. But I just want to remind you that the best outcome that you can hope for, and this is what you should be focused on, not a 1 or 2 or 5% possible gain that you can make here. But your best possible outcome is that your portfolio outlives you in the long term, not the other way around. That's what you should focus on. That's what you have in your control. And the way you control that is by making decisions about asset allocation, about diversification, about not making the wrong moves at the exact wrong time, and risk management, of course. So we don't want to try to help you or indulge you in predicting the external events, but provide you with some certainty about what these potential events will do in your portfolios. This is how we've engineered the models. We've engineered out a lot of the uncertainty in this whole thing, because do we know when this black swan will come walking around the corner and cause the world to turn upside down and the market to drop 35%? Absolutely not. But I can tell you with certainty, because we've seen it. If you're in the growth and income model with us, for instance, and the market drops by 40%, we know that you will only be down 16 or 18%. We know that your drawdown will only be 40, 45%. And we also know that your upside, the amount of upside that you capture on a 40% move up, is about 70%. That's a predictable outcome. And that provides peace of mind, which was why we're in business. We're in the peace of mind business. So with that said, I want to spend just a couple of moments on the models and what they're doing. And if you do have questions, please send them in the chat. And when I can identify where the chat is again, because there's all sorts of things on my screen, I will look at it. So the growth and income model, which is the largest model we run, it's about 70% of the group. We're going to address that right now. So that is essentially a model that ranges anywhere from about 60 to 65 or 66% in stock. And let me stop sharing the screen. This is a little distracting. All right, here I am. There you are. Hey, everybody. So the growth and income model is, part stock, part bond, a little bit of cash, some alternatives. And the benchmark that everybody knows, benchmark meaning who do we compare this to, is the S&P 500. It's the most ubiquitous benchmark, so that's what we use to compare. Now, from January 2nd, the first trading day of the year, through September 11th, which was Friday, the S&P 500 did 2.95%. And the average return in this model was about 4.7%. Now, let me explain why I say the average return. Because some of you came at different times. Some of you have very large positions that I can't do anything with because your grandpa bought it for you in 1941 and it's split 18,000 times and it'll create a huge amount of taxable gain. So the models are the same, but sometimes the percentages of what's in there are a little different. So the range of returns in this model was anywhere from 4.1 at one side of the bell curve, and then there was one person, which I'm frankly still trying to figure out, got close to 8%, and I'm trying to figure that one out. But for the most part, they were all in the high fours, low fives, and I was really happy to see that. So this is an important fact, and it's not nerdy, but I want you to listen to it because it's relevant. There's something called beta. Beta is a measurement of risk, and it's a measurement of risk of your portfolio or a position relative to a benchmark. The benchmark we use is S&P. The S&P has a beta of 1. That is a fact. It is a beta of 1, and you measure things relative to it. So if you have a stock that has a beta of 1.2, it's 20% more risky or more volatile than the S&P, and vice versa. If you have something that's 0.75, it's 25%. So now that everybody's eyes are glazing over, here's the payoff. The payoff is, in our model, the beta is 0.67. Therefore, we have a, 45, 50% greater return with the beta of 67, which means we're 33% less aggressive. So we are winning by not losing. And in very real terms, one reason that we're beating the market is because as the market imploded through end of February and into March and April, we didn't have a 35% drawdown. The arithmetic of that drawdown was we only had to come back up again about 19%. if you were in the S&P and you wrote it down 35%, you had to come back up about 58%. Also, during that time, we were buying stock hand over fist. We didn't just ride it down. We were buying it at the low points. So that's kind of the mechanics of how the models are working. And for the record, just to be fair, from April 1st through September 11th, the S&P 500 was up 34 percentage points. Our model, right on cue, was up 22%, just like it was supposed to be. And this is what we want. We want that predictability. So, once again, here's your takeaway. And this is what I'd like you to walk away from this conversation with, and that is, when it comes to reacting to external events, like something exogenous like this COVID or something else, do less, not more. The odds favor you. And that's the whole point here. We want to increase the odds of your success. The other thing I want to implore you to do is, if you haven't spoken to us in a while, I actually think most of us have talked a lot, but if you want to schedule time to talk about this or what Tom went through or anything else, get on our calendars. We want to talk to you about this. We have other models, obviously, that you may want to hear about, that you may be in. And certainly invite a trusted friend or somebody in your family to do a call with us. The amount of wealth that you can help them create or help yourself create by making these types of moves over time will be many multiples of where it is now. And it will be well worth your time and effort. So with that said, I'll turn it back over to Tom for a moment, and certainly, please either, or Lizzie will give you the directions on how to send some questions. Tom?
Thanks, Doug. So, look, we're really just entering into another phase of volatility that Doug spoke about. We entered into a phase of volatility in March that, had a little bit more of a scare, because everybody thought, all of us thought we were going to die and our money would be worthless. So like it really mattered to us, right? But, that's what March was. And what March has shown, at least from all the conversations I've had since we've recovered as well as we have, and this is different than 2008, right? Because it was so much quicker, that markets do recover. They bottom out. We just don't know where it is. And then they go into recovery. We don't know how long it takes, right? The election, I think that the 2000 election bottomed out on 12/20, I think. And, so I don't know the number of weeks there. I certainly do remember all the conversations. 5 weeks?
Yeah.
So I certainly do remember all the conversations. I do remember all the fear, right? And then we went into, we just continued into this downturn that was already happening, right? Again, the market is a cycle. The economy is a cycle. It didn't go down because Bush had won. It went down because the market is a cycle, right? And we were in a down cycle. So I don't really want to tell you what kind of cycle we're in tonight. We'll need another hour for that and a lot more study and research on our part. We seem to be all pretty positive. I know all of us on the call are hoping we're going to stay pretty positive. And I think that happens no matter who wins. So, I've had calls as early as or as late as 3 o'clock here in my office about the election. And, I gave them a precursor to what was going on tonight. And that's where this stands, right? This is truly historical data telling us every election is different. So when people tell me, well, this time is different, of course it is. It's Trump versus Biden. We've not had that before. And that's the difference, right? So I think just, let us do our work as we did in March, right? As Doug alluded here, the work that was done on not just the growth and income, but all the models was excellent. Here we are with the growth and income as the highest model that is used because it fits most of our clients really well. Here we are at this number that exceeds the S&P. I think as a firm, and maybe Doug or Dan could correct me, we had 2 people sell out. We had 1 get back in at my urging and urging and urging, and he did. And we're all thankful, and he's thankful. 1 didn't. And the outcome for them is they just wrecked their retirement. They will not get back in until it goes back down to where they got out, and that's not going to happen, right? The probability of that happens pretty small. So, hey, this is what we get paid for, right? We get paid to manage the money. We get paid to make the changes as we see fit is necessary. As I told 1 client back in 2016 when he sold out twice, I said, I said, I'm going to send you your money because you don't need me. You make the decisions. You like to buy high and sell low, right? That's what he liked to do. And he did. And the only account I've ever had in my career that had a negative average annual rate of return, I told him you'd be better off in 1% CDs. That's what they were back then, right? So, look, I think that probably what was expected here tonight was we were going to pick Trump, we were going to pick Biden, or we're going to beat up on one or the other. And, I don't even know who Doug's voting for, and he doesn't know who I'm voting for. I don't even know if he's a Democrat or Republican, and he doesn't know if I am, believe it or not. These are conversations that are not relevant to what we do in our work, right? They're all irrelevant. And so as we get through this, right, and we'll be done in X number of days, it's around 50, some number in the 50s, I believe, right? We'll all know the result that day, right, which we both believe will be contested. We won't know the actual winner, but it has to come out sometime, most likely in December. So we will all know in short order. Go back to the virus, right? I mean, that was horrible for most people, right? Especially our clients. I mean, I've never worked harder in my life, never longer in my life. And here we are, we got everybody through it except 1. And here we are with positives. Unbelievable. If you thought back in March, we would be positive and the markets would be positive, we should hire you, right? Because everybody thought this was the end, right? And the same event will happen here. It should not be naturally as deep, anywhere near as deep as the virus. So with that, Doug, I really don't have much else to say. I'm happy everybody was able to make it
Thanks, Tom.
tonight.
So Lizzie, do you want to set everybody up for questions if they'd like?
Yeah, so if anyone has any questions, there's a little chat panel on the bottom of your Zoom screen. If you just go over it with your mouse, it'll pop up. And so if anyone has any questions, please feel free to write them in there and we'll try to answer all of them.
Well, they can talk, right?
Yeah, and of course you guys can talk. You can just unmute yourself or send me a chat if you're not able to, but yeah, you can either use your audio or you can send it in the chat box, whatever is easier.
Okay. So what we'll do is we'll wait a moment or two and, during that time, I'll tap dance or something. So, what I will tell you is that we do have certain buy and sell disciplines. I think I've spoken to all of my clients about this in great, depth over the years. And, essentially we buy based on fundamental analysis, which is the difference between fundamental analysis and technical. Is technical is you're looking at the charts and it's kind of voodoo. You're looking at price action and previous. Fundamental analysis is earnings, cash flow, dividends, things that we're looking at in terms of a qualitative viewpoint of a business, and we'll stick them in. And, I'll tell you that one of the things that we did, that really worked out well during the last several months is we did a lot of old school investing. As you know, I'm not really big on individual stocks, but we now have about 21 or 22 positions. And all we did was we bought good balance sheets. We looked for things that had strong cash flow. We looked for things that were not going to get beat up because of COVID. We looked for things that had, decent chance in a recession. We looked for things that had good earnings growth, and we stuck them in the portfolio. And, you know, I think my favorite story I've told Tom is that, you know, you could buy UPS and it's literally, it's more fun to watch paint dry on your wall than to watch what UPS trades. UPS all of a sudden is $89. And I'm like, finally, I get to buy UPS because otherwise it sits there between $100 and $110 and never goes anywhere. And I see UPS and I grab it. I think it was like March 19th. UPS is something like $180 now. All of a sudden, UPS has its moment because everybody's sitting around trying to figure out how can they have an office at home and buying things, you know, to set up, you know, a backyard playground and, you know, desks and things for their kids, and they're imposing surcharges, and all of a sudden UPS has earnings growth. So we're doing a lot of very fundamental, you know, analysis, and it's really a fun way to build the portfolios because it makes things very predictable. It's very easy to handicap that. I could tell you that for the first time in my career, I felt complete certainty over equity versus bonds because bonds were completely disconnected from any type of reality, you know, in the last several months. At least with equity, it's very transparent. I can see earnings. I can make a decision about what does this really look like in terms of evaluation at this moment versus what's going to happen over time. And I had a lot of fun with it. And, you know, I hate to see bad things in the market because everybody gets stressed, but I'll tell you, that's when we do our work and that's when we make you some money because we have a list and we know exactly what we want to buy, and we're always willing to share that with you. It's not a trade secret. So we're not really getting any questions. I'm sure people will reach out to us offline as they do. And, you know, with that said, I'll say goodnight to everybody. I was scrolling through and seeing some smiling faces and my old friends. And I see Dan there. What's up, Dan? And Lizzie, great to see you from Tallahassee. Fancy apartment. Tom, great job on the deck, and we'll speak with everybody soon, okay? Have a great night, and we're here if you need us.